Hello, and welcome back to the Mortgage and Protection Podcast. And Paul Holland from Henchurch Lane joins us now to continue answering your questions on self-employed mortgages. Great to chat with you again, Paul. How's it all going?
Very well. Thank you, Tessa. How is everything at your end?
Good. I'm glad to hear that. And yes, all good too. Thank you. So we've got two parts left, haven't we, of our self-employed mortgages episode. So we've got three other questions here to cover. So should we get straight into them?
Let's do it.
All right, then. So, first of all, then, what are the typical deposit requirements for self-employed mortgages?
Okay, so with a conventional mortgage, the typical deposit requirement for self-employed applicants starts from as little as 5%. As long as you can bridge the remaining 95% gap with a mortgage, and that's going to be predominantly based on your affordability, then that can be achieved. If you can't do that, then of course, one of two things are going to have to happen. Your deposit will need to be larger, or the property price will need to be smaller. And we always say the larger the deposit, the better. We've said it 100 times on this podcast. And the reason for that is because things just tend to become a lot easier every time you reach a bigger bracket. So 10%, a little bit easier. 15% deposit, easier again. 20% deposit, obviously you get the gist. But in conclusion, it is possible for self-employed people to purchase via a conventional mortgage with as little as 5%. But the deposit really just scratches the surface when it comes to complexities around self-employed people securing mortgages, as we know.
Right. Okay. So hopefully that is clear there, because like you've said, we've covered it on quite a few of the episodes, haven't we? So let's move to the next question then. So what if someone has a short trading history but a good income?
Okay, so a short trading history is generally the biggest problem that we experience from self-employed applicants when it comes to getting their mortgage. However, if it's coupled with a good income, it can make things much easier. So if you've been trading for a year and you've submitted a set of accounts to HMRC, at that point, generally you can secure a mortgage. The size of that mortgage, though, is really going to depend on the success of your first year, along with any additional income on the application. So income from other sources such as land and property, or other applicants, so your partner on the mortgage application with you. Generally, the reason that this is a problem, companies in their infancy might not profit as much as they're going to when they're a fully established business. Of course, that isn't always the case. So you could have switched from an employed role to a sole trader or a limited company in the exact same role, maintained all of your clients, and you might earn as much in the first year as you have historically. But if you're starting from scratch in a new industry, if you start halfway through a financial year, so you've only got a portion of the year to give it a good go, or if you're initially spending a lot of time building a client bank or winning contracts, then it could take a little bit longer for you to start spinning that profit that you're going to need to afford the mortgage that you're after. So it's worth bearing that in mind. If you're lucky enough to do well, or well enough in your first year, then you can get a mortgage realistically from that point.
Okay, so good news there, but again, a few points to bear in mind, as you've said as well. So just lastly then, for our part 6 of self-employed mortgages, how important is a deposit for a self-employed mortgage application? So we've kind of covered this, haven't we? But
Yeah,
just to confirm.
absolutely. Just to confirm, it's imperative. As we previously mentioned, a conventional mortgage will require that 5% deposit at the very least, and that's subject to all of the other numbers and all of the other criteria fitting as well. So if you're buying your first home, then that deposit's going to come from your own savings, a gift from a family member. And believe it or not, there are lenders out there that will allow you to borrow money on an unsecured basis to fund your deposit. So that's worth noting. You just need to make sure that it's not borrowed from the same bank that you're applying with. And once you factor in those monthly repayments for that loan, it's not going to throw out the affordability on the mortgage and make it not affordable anyway. So bear those things in mind if you do entertain that option. If you're selling a house in the process, however, then hopefully there's a little bit of equity or some equity tied up in that property, and that's going to fund your deposit on the onward purchase. But unless you're utilising some sort of special scheme that we haven't covered in this section, a deposit is very much key to the whole thing working.
Right. Okay. There we go. Well, we've got one part left, haven't we? Part 7. We've got 3 last questions to cover. And then that
Yep.
concludes I suppose we can call this a self-employed series, but we will
Yep.
go on to cover more episodes. We'll kind of niche down, won't we, on the self-employed industry. So you can
We
look out
will,
for
yeah.
those
Series
episodes.
we can call it. I don't think it's going to make it to Netflix or anything like that, but it's certainly a series of questions, wasn't it?
Definitely. As long as it's helping people out, hopefully these short, fiery questions and episodes are as well.
Yeah,
I think it helps when there's not too much information being thrown at you, but there we go,
I
just
agree.
breaking it all down there. Okay. Well, thank you for that, and we'll speak to you next time.
Take care, Tessa.